Before we begin, please remember that I am not a licensed financial advisor or insurance professional. The information provided in this video is for educational and informational purposes only and should not be considered legal, financial, or insurance advice. You should always consult with a qualified and licensed professional for advice tailored to your specific situation. Your financial decisions are your own responsibility. You get the letter in the mail. Your heart sinks before you even open it because you know who it's from. Your car insurance company. You tear it open and there it is in cold, hard print. We regret to inform you, your policy is being non-renewed, canceled, dropped, or maybe it's not a cancellation letter. Maybe it's even worse. It's a renewal notice, but the price has doubled or tripled, all because of one mistake, one speeding ticket, a minor fender bender. Maybe you were late on a few payments, not to your insurance company, but on a credit card, and now their secret algorithm has flagged you. Suddenly, you feel like a criminal. You feel trapped. How are you going to get to work? To the grocery store? How are you going to live your life? You need a car. And in America, to drive a car, you need insurance. If that story sounds familiar, you are not alone. Not by a long shot. A staggering 1 out of every 3 drivers in the United States could be classified by insurance companies as high risk. Think about that. Nearly 80 million people. 80 million drivers who have been told by the mainstream insurance industry that they are too much of a gamble. They're too risky. They don't fit into the neat, perfect little box of a preferred customer. And because of that, they're either denied coverage outright or they're forced to pay absolutely astronomical premiums that can feel like a second car payment. For decades, the big-name insurance companies you see on TV, the ones with the funny mascots and the catchy jingles, have spent billions of dollars to convince you there's only one way to buy insurance. They've built a system, a black box of data points and risk calculations that judges every aspect of your life. Your age, your zip code, your credit score, your driving record, the type of car you drive. If even one of those things falls outside their perfect, profitable little model, you're out. They'll show you the door. And they leave you feeling lost, frustrated, and thinking you have no other options. But what if I told you there's an entire parallel universe of car insurance that those big companies almost never talk about? A massive multi-billion-dollar industry designed specifically for those 80 million drivers they've cast aside. It's called the non-standard auto insurance market. And for many people, it's the only thing that keeps them legally on the road. It's the lifeline when you've been told no by everyone else. In this video, we are going to pull back the curtain on this hidden world. We're not just going to tell you what non-standard insurance is. We are going to arm you with the knowledge to conquer it. We will break down exactly who this insurance is for, why it exists, how it's different from the standard insurance you're used to, and most importantly, how you can navigate this market like an expert to find the best possible coverage at the fairest possible price. By the end of this, you will no longer be at the mercy of a cancellation letter. You will be in control. You'll understand the game, you'll know the players, and you will have a clear roadmap to get insured and get back on your feet. So, who exactly ends up in the non-standard market? You might be surprised. The stereotype is the reckless driver with a dozen speeding tickets and a DUI. And yes, those drivers are certainly here. A DUI or DWI conviction is one of the fastest tickets to the non-standard market. But the reality is so much broader. Maybe you're a young driver under 25 with a perfectly clean record, but because of your age, statistically, you're considered a higher risk. The standard companies quote you $400 a month. Welcome to the non-standard market. Maybe you're an immigrant or a foreign national with a valid international driver's license, but you don't have a U.S. driving history. The standard system sees you as a complete unknown, a blank slate, which to them is the same as being a high risk. Welcome to the non-standard market. Perhaps you let your previous insurance policy lapse. Maybe money was tight for a month and you missed a payment. You went just a few weeks without coverage. To a standard insurer, that's a massive red flag. They see it as instability and irresponsibility, even if it was just an honest mistake. Guess what? Welcome to the non-standard market. Or maybe your driving record is spotless, but your credit score took a hit. You went through a divorce, had a medical emergency, lost a job. Things that have absolutely nothing to do with your ability to press the brake pedal. But because insurance companies have found a correlation between low credit scores and a higher likelihood of filing claims, they penalize you for it with sky-high rates or an outright denial. You got it. Welcome to the non-standard market. It also includes drivers who need to file in State Route 22 or an FR 44. These are special forms, a certificate of financial responsibility, that your state DMV requires to prove you have insurance, usually after a major violation like a DUI or driving without insurance. Most standard carriers won't touch in-state Route 22. The non-standard market is built for it. And it even includes people with exotic, high-performance, or heavily modified cars. Your standard insurer's algorithm just doesn't know how to price a Lamborghini or a classic hot rod. The non-standard market has specialists for that. The point is, this isn't just a market for so-called bad drivers. It's a market for people whose lives don't fit into a perfect, predictable spreadsheet. It's the market for real life. So why does this separate world even exist? It all comes down to one word: risk. Insurance at its core is a business of managing risk. The big, preferred insurance companies want to make as much money as possible, and they do that by insuring the safest, most predictable drivers they can find. They create what's called a risk pool. Imagine a giant swimming pool, and everyone in it pays a fee to be there. This fee is their premium. When someone has an accident, they take money out of the pool to pay for the damages. The standard and preferred companies want their pool filled with Olympic swimmers who almost never need a lifeguard. They want people with 800 credit scores, 30 years of accident-free driving, who own a home in a safe suburb and drive a sensible sedan. These people pay into the pool but rarely take money out. It's an incredibly profitable business model. But what happens when a driver comes along who looks a little less predictable? Someone who might need the lifeguard more often? The standard company has two choices. They can charge that person an enormous fee to get into their pristine pool, hoping it covers any future costs, or they can just deny them entry altogether to keep their pool safe and profitable. This is where non-standard insurance companies come in. They looked at everyone being turned away from the fancy Olympic pool and decided to build a different kind of pool. A pool specifically for the rest of us. The non-standard risk pool is by design filled with people who the data says are more likely to file a claim. Because the overall risk in this pool is higher, the average price, the average premium, is also going to be higher for everyone. That's just the math. They are taking on the risk that the other guys refuse to take. They are the specialists in underwriting life's complexities. They've built their entire business model not around the perfect driver, but around the real driver. And by doing so, they provide an absolutely essential service that allows millions of people to maintain their livelihood, their freedom, and their ability to function in society. Without them, countless drivers would have no legal way to be on the road. Understanding this fundamental difference is the first step to taking control. You're not being punished. You're just being placed in a different category based on a business calculation of risk. It's not personal, it's just math. And once you understand that, you can start to learn the rules of this new game and figure out how to win. And that's exactly what we're going to do. We'll show you how to find the reputable companies in this space, what to look for in a policy, and the critical mistakes you must avoid that could cost you thousands. We're just getting started. So let's pull back the curtain. The first thing you have to understand is that the auto insurance world is split into two distinct universes. There's the one you see in all the commercials, the standard or preferred market. This is the home of the big-name carriers with funny mascots and catchy jingles. They spend billions of dollars a year to convince you that insurance is simple, friendly, and always there for you. And for about 80% of drivers, it is. They cater to what they call the preferred risk, drivers with clean records, good credit, and a long history of continuous coverage. Their entire business model, their algorithms, their pricing, it's all built on the predictable low-risk nature of this group. But what happens when you no longer fit that perfect mold? What happens when life gets messy? This is where the second universe comes in, the non-standard market. This isn't a place anyone chooses to be. It's a place you end up. And the reasons for landing here are more common than you think. Maybe you got a DUI. That's the most obvious one. But it could be much less severe. It could be 2 at-fault accidents in 3 years. A handful of speeding tickets. It could even be a lapse in your insurance coverage for more than 30 days because money was tight and you had to choose between paying your rent and your premium. For millions of Americans, the reason has nothing to do with their driving at all. It's a low credit score. Insurance companies have mountains of data that, rightly or wrongly, show a correlation between credit history and the likelihood of filing a claim. So if you've hit a rough financial patch, you can be labeled high risk, even with a spotless driving record. Young drivers, new drivers, people who have just moved to the country and have no US driving history, they all get funneled into this market. Even the car you drive can do it. That souped-up sports car or a vehicle with a salvaged title from a previous accident. That's a red flag for standard insurers. Let's make this real. Meet David. For 10 years, David was the perfect customer for his big-name insurance company. He paid his premiums on time, never had an accident, never even got a ticket. Then, in the span of 6 months, his luck changed. He got a speeding ticket on a cross-country road trip, and then a few months later he had a minor fender bender in a parking lot. Clearly his fault. When his policy came up for renewal, he got a letter in the mail. It was a cold, impersonal notice of non-renewal. His trusted insurance partner of a decade was cutting him loose. David was shocked. He called them confused. The agent on the phone was polite but firm. His risk profile had changed. He no longer met their underwriting guidelines. They couldn't offer him a policy at any price. Suddenly, the company with the friendly commercials felt like a fortress with the gates slammed shut. David was now on the outside, labeled a high-risk driver, and cast into the non-standard market. This is a critical point to understand. The standard companies aren't being evil when they do this. They're just being machines. Their business is a game of statistics and probability. They've built a highly profitable machine that runs on clean data and predictable outcomes. When a driver like David introduces unpredictable variables, the ticket, the accident, he messes up the algorithm. It's simpler and more profitable for them to just remove the variable, to non-renew the policy, than to recalculate the risk and charge the much higher premium his new profile would require. They are essentially saying, "We are not equipped to properly price your risk anymore. Go find a specialist." And that's exactly what non-standard insurance companies are. They are specialists in pricing risk. Their entire business model is built for the drivers the standard market rejects. They don't spend billions on Super Bowl ads. They spend their money on actuaries and data scientists who can precisely calculate the probability of a driver with a DUI getting into another accident, or the financial risk of insuring someone with a 500 credit score. They're not bad companies. They're just playing a completely different, higher stakes game. This brings us to one of the most feared and misunderstood terms in this entire world: the State Route 22. You might have heard it whispered like some kind of automotive curse. But what is it, really? Let's be crystal clear. And State Route 22 is not insurance. It is not a type of policy. It's simply a piece of paper. It's a certificate, a form that your insurance company files with your state's Department of Motor Vehicles. That's it. This form is a guarantee from the insurance company to the state, and it says one thing: we certify that this person is carrying at minimum the legally required amount of liability insurance in this state. The state, through the DMV or a court order, is the one who tells you that you need in State Route 22. This typically happens after a major violation. A DUI or DWI is the most common trigger, but it can also be required for driving without insurance and getting caught, reckless driving convictions, or having too many points on your license. The state essentially says, "Okay, you've proven you're a high-risk driver. We don't trust you to stay insured on your own. So for the next 3 years, we are requiring you to have an insurance company vouch for you." This is another reason people get pushed into the non-standard market. Most of the big standard insurance companies, they won't file in State Route 22. It's too much administrative hassle, and frankly, they don't want the type of customer who needs one. So you have no choice but to find a non-standard carrier that specializes in it. The process is simple. The court tells you that you need in State Route 22 for, say, 3 years. You call an insurance provider that offers this service. You buy a policy from them, and for a small filing fee, usually around $25, they will electronically file the State Route 22 with the state DMV on your behalf. Your license suspension is lifted, and you can legally drive again. But here is the razor's edge. This is the part you cannot forget. The State Route 22 creates a direct link, a tether, between your insurance policy and your driver's license. They are now fused together. If you miss a payment, if you let your policy cancel for any reason, the insurance company is legally required to immediately notify the state. They do this by filing another form, and State Route 26, which says, "Our guarantee is over. This person is no longer insured." The moment the DMV receives that State Route 26, your license is automatically and instantly suspended again. There's no grace period, no warning letter. It's a switch being flipped. This is the trap. You're paying a high premium, life gets in the way. You miss a payment by 1 day, the policy cancels, the State Route 26 is filed, and now you're driving on a suspended license without even knowing it. If you get pulled over, you're not just facing a ticket, you're facing a much more serious charge, potentially vehicle impoundment, and an even longer period of required state Route 22 coverage. The game is rigged to be unforgiving. So now you understand the landscape. You know why this market exists, who it's for, and the mechanics of its most common tool, the state Route 22. You're no longer in the dark. But knowing the rules of the game is one thing. Knowing how to identify the players is another. The non-standard market is a wild west of different companies. Some are large, reputable organizations that are simply specialists in this field. Others are small, local operations that can be fantastic. And some are predators. They use deceptive advertising, confusing policy language, and abysmal customer service to profit from your desperation. So, how do you tell them apart? How do you find the legitimate partner in a sea of potential pitfalls? That's where we're going next. We're about to name names and expose the red flags you need to look for. Let's start with the most common trap, the digital phantom. You're online maybe late at night and you've just been rejected by another standard carrier. You type high-risk auto insurance into a search engine and you're flooded with ads. The first one you click looks promising. Big bold letters scream, "Get insured in 5 minutes. Guaranteed approval. Rates as low as $19 a month." A countdown timer is ticking away in the corner of the screen, creating a false sense of urgency. This is red flag number 1, the high-pressure sales funnel. Legitimate insurance isn't an impulse buy. It's a contract. Any website that tries to rush you into a decision with countdown timers, claims of only 3 spots left at this rate, or pop-ups that won't go away is designed to make you panic, not to make you informed. They want you to click buy before you have time to read the fine print or compare offers. A real insurance provider wants a long-term customer, not a one-time score. They provide information and give you space to make a choice. A predator creates a pressure cooker. Closely related is red flag number 2. Vague promises and no identity. Look at that website again. Does it list a physical address? A real phone number that connects to a human, not just a recording? Can you easily find the company's official name like the XYZ Insurance Company of America? Or is it just a generic brand like Insta Auto Coverage now? Predatory operations hide in the shadows. They use stock photos of smiling families and avoid giving you any concrete details. Their language is all fluff and no substance. They'll say, "We work with hundreds of top carriers but never name them." They'll promise the best coverage, but won't let you see a sample policy document. A legitimate company, even a non-standard one, is proud of its identity. A company like Progressive or the General will have their name plastered everywhere. You can easily find their corporate headquarters, their licensing information for your state, and multiple ways to contact a real, licensed agent. If a website feels like a ghost, it's because it probably is. It's a front, designed to capture your information and nothing more. This leads us to the most infuriating trick in the book. Red flag number 3. The bait and switch quote. This is how they get you on the hook. You fill out their simple one-page form. You enter your name, your car, maybe 1 or 2 minor details, and instantly a magical number appears, $45 a month. Seems too good to be true because it is. You click next, and now you're on the phone with a very slick, very fast-talking agent. Suddenly, that $45 quote isn't real. "Oh," they'll say, "that was just a preliminary estimate. Based on your specific zip code, we need to add a regional adjustment fee. And because of the age of your vehicle, there's a mandatory equipment surcharge. And of course, there's our standard policy administration fee." By the time they're done, your $45 quote has ballooned to $150, and they're pressuring you to lock it in right now with your credit card. This is a calculated deception. They lure you in with an impossible price and then rely on your desperation and the time you've already invested to bully you into accepting the real inflated rate. So who are the legitimate players? Who can you trust? While we can't endorse any single company, we can name the established major providers in the non-standard space so you know what a real one looks like. These are companies that are household names for a reason. Think of companies like the General. Their entire business model for decades has been built on serving the non-standard market. They are upfront about who they are and who they serve. Then you have giants like Progressive. They are one of the largest auto insurers in the country, and they have a massive, sophisticated system for pricing risk, which allows them to effectively write policies for a huge range of drivers, including many in the non-standard category. Geico, another giant, does the same. You might also encounter names like Safe Auto, Dairyland, or Bristol West, which is part of Farmers Insurance. These companies are not fly-by-night operations. They are licensed in the states they operate in. They are regulated by each state's Department of Insurance. And crucially, they have financial strength ratings from independent agencies like AM Best. A strong rating means the company has the actual cash reserves to pay out claims if you get in an accident. A phantom website doesn't. The key takeaway is this: the legitimate players aren't hiding. They are large, established, and regulated. They may not be the cheapest, but they are real. This brings us to a critical distinction you need to understand. Red flag number 4. The lead generator masquerade. Many of the websites you'll land on are not insurance companies or even insurance agencies. They are something called a lead generator. Their only business is to get you to fill out a form with your personal information, your name, address, phone number, email, driving history, and then they sell that information, your lead, to dozens of different agents and brokers for a fee. You'll know you've hit one of these sites because the moment you click Submit, your phone will begin to explode. You'll get calls, texts, and emails from numbers you don't recognize, all from different agents trying to sell you a policy. It's an absolute nightmare. The way to spot these is to scroll all the way to the bottom of the page and read the fine print. You'll almost always find a sentence that says something like, "By submitting your information, you consent to be contacted by our marketing partners via telephone, text message, and email." That's the code. It means they aren't going to help you. They are going to sell you. A real insurance company's website, like Progressive.com, is designed to give you a quote directly from them, not to sell your data to the highest bidder. Finally, let's talk about money. Red flag number 5. Unconventional payment demands. This is perhaps the most obvious and dangerous red flag of them all. Let's say you've gone through the process and you're ready to buy a policy. The agent tells you to pay your down payment. But instead of a secure credit card portal or an electronic funds transfer from your bank, they ask for something strange. They might ask you to wire money through Western Union. They might ask you to go buy a prepaid debit card or a gift card and read them the numbers over the phone. They might ask you to send money via a cash app like Zelle or Venmo to a personal account. You must stop immediately. No legitimate insurance company in the United States will ever ask you to pay for your policy with a gift card. These methods are untraceable and irreversible. It's the preferred payment method of scammers because once you send that money, it's gone forever, and so are they. You'll be left with no policy, no coverage, and no way to get your money back. Legitimate companies use standard, secure, and traceable payment systems. Major credit cards, debit cards, and direct bank drafts, known as EFT. Anything else is a scam. So you've navigated the minefield. You've avoided the pressure tactics, the phantom websites, the bait-and-switch quotes, the lead generators, and the payment scams. You've found a reputable, established, non-standard carrier that's willing to offer you a policy. You're finally on the verge of getting back on the road legally and safely. But now comes the hard part. The quote they give you is still high. It's a legitimate quote, but it's stretching your budget to the breaking point. How do you know you're not overpaying? How do you read through that complex policy document, filled with jargon like collision deductibles, bodily injury liability limits, and uninsured motorist coverage, to find the hidden discounts you qualify for and trim the expensive fat you don't actually need? Getting a policy from a good company is only half the battle. The other half is making sure it's the right policy at the best possible price. And that's exactly where we're going next. We're about to decode the policy itself. When you get your insurance documents, whether in the mail or online, it can feel like you've been handed a legal textbook written in another language. But there's one page that matters more than all the others. It's your cheat sheet, your Rosetta Stone for understanding exactly what you've paid for. It's called the Declarations page. Think of the Declarations page or DEC page as the one-page summary of your entire contract. It answers the most important questions: who is covered, what is covered, when are you covered, and for how much. If you only read one page of your policy, make it this one. Let's break it down piece by piece. First, you'll see the named insured. This is you, the person who owns the policy. It will also list your address. This section is critical because it defines the primary person the policy is built around. Right below that, you'll often see drivers. This is where you must list everyone who will be regularly driving your vehicle. Your spouse, your teenage kid who just got their license, even a roommate who borrows your car for groceries every week. Be honest here. Hiding a driver, especially a high-risk one, to get a lower rate is one of the fastest ways to get a claim denied. If your unlisted teenage son wrecks the car, The insurance company could legally say, "We didn't agree to cover this risk," and walk away, leaving you with the entire bill. Next, you'll find the policy period. This shows the exact date and time your coverage begins and ends. It's usually a 6-month or 1-year term. Pay close attention to the expiration time. It's often 12:01 a.m. on the date listed. This means if your policy expires on July 15th, you are not covered for your morning commute on July 15th. There is no grace period. The moment that clock ticks over, you are uninsured. For non-standard drivers who are often on month-to-month plans, this is life or death information. Set a reminder on your phone a week before it expires. Do not let it lapse. A lapse in coverage, even for a day, can cause your rates to skyrocket and can put you in a terrible legal and financial position. Then you'll see the covered vehicles. This lists the year, make, model, and most importantly, the vehicle identification number, or VIN, of each car on your policy. Double-check this. A single typo in the VIN could lead to a claim being delayed or even denied because on paper, they weren't insuring the car that was actually in the accident. Now we get to the heart of it all, the main event. The section labeled coverages, limits, and premiums. This is the menu of protections you've purchased, and it's where most people get confused. Let's make it simple. First up is the one you legally have to have, liability coverage. This coverage does not pay for your car or your injuries. This is crucial to understand. Liability is for the other guy. It pays for the damage you cause to other people's bodies and other people's property. When you see a string of numbers like 25/50/25, that's your liability limit. It's not a random code. It's a promise from your insurance company, and it breaks down like this. The first number is the bodily injury liability limit per person. Let's say it's $25,000. If you cause an accident and injure one person, your insurance will pay up to $25,000 for their medical bills, lost wages, and pain and suffering. The second number is the bodily injury liability limit per accident. If that number is $50,000, it means that if you injure 3 people in one accident, your insurance will pay a maximum total of $50,000 to be split between all of them. It doesn't matter if their combined medical bills are $100,000. Your policy stops at $50,000. The third number is the property damage liability limit. If it's $25,000, that's the maximum your policy will pay to repair or replace any property you damage in an accident you cause. This is usually the other person's car, but it could also be a mailbox, a storefront, or a city light pole. Now let's be brutally honest. These state minimum limits, which are common on non-standard policies, are dangerously low. The average price of a new car in America is now over $48,000. If you rear-end a brand new Ford Explorer with your $25,000 property damage limit, you are already underwater. And what if you hit a BMW or a Tesla? You could be short by $50,000, $60,000, even $70,000. And where does that money come from? Comes from you. They can sue you for it. They can garnish your wages for years. They can put a lien on your house. Choosing the absolute legal minimum liability is like showing up to a gunfight with a butter knife. It's technically a weapon, but it's not going to save you. If you can afford it, increasing your liability limits is the single smartest thing you can do to protect your financial future. Next on the menu is uninsured or underinsured motorist coverage, often abbreviated as UM/UIM. If liability is a shield to protect others from you, this is the shield that protects you from others. Specifically, it protects you from the 1 in 8 drivers in this country who are illegally driving without any insurance at all. If one of them hits you and you're injured, who pays your medical bills? Who pays for your time off work? Their non-existent insurance certainly won't. This is where uninsured motorist coverage steps in. It acts like the at-fault driver's insurance and pays for your injuries and damages. Underinsured motorist is similar. It kicks in when the person who hits you has insurance, but their low liability limits aren't enough to cover your bills. This coverage is not always required by law, but in today's world, it is absolutely essential. To drive without it is a massive gamble. Now let's talk about the coverages that actually fix your car. This is what people are usually talking about when they use the slang term, full coverage. But full coverage isn't a real insurance term. It's typically a combination of 2 separate coverages, collision and comprehensive. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, be it another car, a guardrail, a tree, or a garage door. Pays out regardless of who is at fault. If someone runs a red light and T-bones you, collision pays. If you slide on ice and hit a pole, collision pays. This coverage comes with a deductible. A deductible is the amount of money you have to pay out of pocket before the insurance company pays a dime. If you have a $1,000 deductible and the repairs cost $8,000, you pay the first $1,000, and your insurer pays the remaining $7,000. A higher deductible means a lower monthly premium, but more pain if you have a claim. Comprehensive coverage is sometimes called other than collision. It covers damage to your car from almost everything else. Think of it as the life happens coverage. If your car is stolen, comprehensive pays. If a hailstorm makes it look like a golf ball, comprehensive pays. If a deer jumps out in front of you, if a tree branch falls on your roof, if your car catches fire, or if it's vandalized, that's all comprehensive. Like collision, it also has a deductible. For non-standard drivers, this is where you can make strategic decisions. If you're driving a 15-year-old car that's only worth $2,500, does it make sense to pay an extra $60 a month for collision coverage with a $1,000 deductible? You're paying over $700 a year to protect a maximum payout of just $1,500. The math might not work. You might be better off banking that money for a future car. This is a personal choice, but you need to make it with your eyes open. Finally, you might see medical payments coverage, or MedPay, or in some states, personal injury protection, or PIP. This is your first aid kit. It pays for medical expenses for you and your passengers after an accident, no matter who was at fault. It covers things like ambulance rides, emergency room visits, and health insurance copays. It's designed to get you immediate medical care without waiting for the insurance companies to fight over who is to blame. In no-fault states, PIP is mandatory and is more extensive, often covering lost wages as well. So, when you look at your declarations page, you're not just looking at a list of terms. You're looking at a series of decisions you have made about your financial security. A non-standard policy might default to just the state minimum liability to give you the lowest possible price, but that price comes with enormous risk. Understanding these coverages is about shifting your mindset. You're not just buying a piece of paper to stay legal. You are building a financial fortress around your life. You are deciding which walls need to be thickest and where you can afford to have a smaller fence. We've opened the box and seen all the pieces. We know what liability, collision, and comprehensive are. But how do they arrive at that final number? That premium that makes you either breathe a sigh of relief or gasp in shock. That's the black box of insurance pricing. In the next part, we're going to pry it open. We'll expose the rating factors from your credit score to your zip code that determine your exact price, and show you which ones you actually have the power to change. Alright, let's crack open that black box. Forget complex algorithms and secret formulas for a second. Think of your insurance premium like a custom-built suit. The tailor, in this case the insurance company, is taking a series of very specific measurements. Some of these measurements you were born with, some are choices you've made, and some are about the world you live in. Each one adds or subtracts from the final price tag. The goal of the insurance company is simple: to predict the future. They are betting on how likely you are to cost them money. Every factor we're about to discuss is just another piece of data they use to place that bet. Let's start with the big one, the measurement that matters more than any other: your driving record. This is the foundation of your entire insurance profile. It's the story you've written on the road. Every speeding ticket, every at-fault accident, every DUI. They aren't just past mistakes. They are, in the eyes of an insurer, statistical predictors of future behavior. Think about a driver we'll call David. For 15 years, David was a ghost. A perfect record. Then one Friday night, a lapse in judgment. An at-fault collision. Not a huge one, but enough to be reported. At his next renewal, his premium didn't just nudge upwards. It skyrocketed. He went from a preferred customer to a high-risk client overnight. Why? Because the data tells the insurer that a driver with one recent at-fault accident is dramatically more likely to have another one in the next 3 to 5 years. And a DUI? That's the nuclear option. It can easily double or triple your rates, land you in the non-standard market for years, and require a special filing called In-State Route 22, which is basically a scarlet letter telling every insurer that you are a significant risk. This isn't a moral judgment. It's a financial calculation. Your driving record is the single most powerful lever in determining your rate, and it's the one you have the most direct day-to-day control over. Next, the tailor measures your car. It's not just about what you drive, but what it costs to fix it, how safe it is, and how likely it is to be stolen. Imagine two drivers with identical records. One drives a 12-year-old Toyota Camry. The other drives a brand new BMW M Series. The BMW driver's premium will be astronomically higher. Why? First, repair costs. The Camry's bumper might cost a few $100s to replace. The BMW's bumper is loaded with sensors, specialized paint, and complex components, costing thousands. The insurer has to price in that potential repair bill. Second, safety. Now this can work both ways. A newer car with advanced safety features, like automatic emergency braking and lane keep assist, might earn you a discount because it's less likely to get into an accident in the first place. But third, and this is a sneaky one, is the theft rate. Your sensible Honda Accord or Ford F-150 might seem unassuming, but they are consistently among the most stolen vehicles in America. Insurers have this data down to the specific model and trim. If you drive a car that's a magnet for thieves, the comprehensive portion of your policy, which covers theft, is going to be higher. Period. Your choice of vehicle is a massive statement about the level of financial risk you're asking the insurance company to take on. Now we get into the personal stuff. The measurements that can feel a bit uncomfortable. Your demographics. Let's talk about age. The data is brutal and unwavering. Young drivers are a massive risk. A 17-year-old male is statistically the single most dangerous person on the road. Their combination of inexperience and developmental brain science that favors risk-taking is a recipe for claims. It's why adding a teen driver to a policy can feel like adding a second mortgage. It's not personal, it's actuarial. The same goes for gender, though the gap is closing. Historically, young men have had higher accident rates than young women, and their premiums reflected that. As you age, the risk profile smooths out. A 45-year-old driver is in the sweet spot. Then, as you get into your senior years, the rates may begin to creep up again, reflecting a statistical increase in accident frequency. Even your marital status gets measured. Married individuals, on average, file fewer claims than single individuals. The theory is that they represent a more stable, risk-averse lifestyle. It might seem bizarre that saying "I do" could lower your car insurance, but to an actuary, it's just another data point that refines the prediction of your future behavior. But of all the personal factors, none is more powerful or more controversial than your credit. This is the X factor. Most people have no idea this is happening. Insurance companies don't use your FICO score, but they use a derivative of it called a credit-based insurance score. And the correlation they've found is undeniable. People with lower credit scores are statistically more likely to file insurance claims. The public outcry is always, what does my credit card bill have to do with my driving? And it's a fair question. The insurer's logic goes like this. A person who is responsible with their finances, pays bills on time, manages debt well, is also more likely to be a responsible person in other areas of their life. They're more likely to get their oil changed on time, replace their tires when they're worn, and generally avoid risky, impulsive behaviors, including on the road. Whether you agree with that logic or not is irrelevant. It is a bedrock principle of modern insurance pricing in most states. The difference can be staggering. Take two identical people, same age, same car, same perfect driving record, living in the same house. One has a 750 credit score, the other has a 550. The driver with poor credit could easily pay double for the exact same policy. It is one of the single biggest hidden penalties for having a low credit score. A handful of states like California, Hawaii, and Massachusetts have banned or severely limited the use of credit in setting auto insurance rates, but for the rest of the country, it is a dominant factor. Finally, the tailor measures the ground beneath your feet. Your zip code, where you park your car at night, your garaging address, can have a bigger impact on your premium than you can possibly imagine. Move 5 miles across a county line, and your rate could swing by 30%. Why? Because risk is local. An insurer looks at your neighborhood and asks, how dense is the traffic? A quiet suburban cul-de-sac has a different risk profile than a chaotic downtown intersection. What is the local crime rate? If your zip code has a high rate of car thefts and vandalism, your comprehensive coverage will cost more. What's the weather like? If you live in Oklahoma's Tornado Alley or Florida's Hurricane Coast, the risk of weather-related damage is baked into your price. They even look at litigation rates. Are you in a sue-happy part of the country where a minor fender bender is more likely to turn into an expensive lawsuit? That goes into the calculation. You are paying for the collective risk of all your neighbors. You could be the safest driver in the world, but if you live in a high-claim, high-crime, high-traffic zip code, you will pay more. So let's put it all together. The black box isn't so black anymore. It's a complex equation fed by these core measurements: your driving history, your vehicle, your age and personal profile, your financial health, and your location. Some of these are beyond your control. You can't change your age, and you're probably not going to move to another state just to save a few $100s on insurance. But look at what you can control. You control what happens when you turn the key. Your driving record is in your hands. You control your finances. Improving your credit score is one of the most powerful ways to lower your premium over time. And you control your choice of vehicle. The next time you're car shopping, you can think not just about the monthly payment but the monthly insurance cost. You have more power here than you think. We've now deconstructed the price. We've seen the raw ingredients that determine what you pay. But knowing the ingredients isn't the same as cooking the meal. Now we need to understand the menu itself. In the next part, we're going to take control. We'll dive deep into the specific types of coverage, from liability to comprehensive, PIP to uninsured motorist, and show you how to build a policy that protects you without bankrupting you. We'll turn you from a price taker into a smart insurance architect. All right, let's start with the absolute bedrock of any auto insurance policy: liability coverage. This isn't for you. Let me say that again. Liability coverage is not for you, it's for the other guy. It's the coverage that keeps you from financial ruin after you make a mistake. Imagine this: you're stopped at a red light, it turns green, and you start to go. But the driver coming from the left doesn't just run the red light. They blast through it and T-bone the car next to you, pushing it directly into your brand new truck. It's a mess. Metal is twisted, glass is everywhere, and people are hurt. In this scenario, the other driver's liability insurance is what's supposed to pay to fix your truck and cover your medical bills. Now, flip that scenario. You're the one who accidentally runs the red light. Your liability coverage is what pays for the other people's damages. It's broken into two main parts: bodily injury liability and property damage liability. Bodily injury, or BI, covers medical bills, lost wages, and even pain and suffering for the people you injure in an accident you cause. Property damage, or PD, covers the cost of repairing or replacing whatever you hit: their car, a fence, a mailbox, even a storefront if you really mess up. When you look at a policy, you'll see these numbers that look like a secret code, something like 25/50/25. This isn't a locker combination. It's your coverage limits, measured in thousands of dollars. The first number, 25, is the maximum amount your insurance will pay for one person's bodily injuries. That's $25,000. The second number, 50, is the maximum total amount it will pay for bodily injuries for the entire accident if multiple people are hurt. That's $50,000. The third number, 25, is the maximum it will pay for all property damage. That's $25,000. Many people, especially in the non-standard market, just get the state minimum requirement. And let me tell you, that is playing with fire. A 25/50/25 policy might be legal, but it is dangerously inadequate in 2024. Think about it. What if you cause an accident that sends two people to the hospital for a few days? Their medical bills could easily soar past your $50,000 total limit. And what happens to the rest of the bill? They sue you for it. The hospital sues you for it. Your assets, your future wages, everything could be on the line. And that $25,000 for property damage? The average price of a new car today is over $48,000. If you total someone's new SUV or even a nice minivan, your $25,000 limit is gone in a flash, and you're on the hook for the remaining $23,000 plus. This is the single biggest mistake people make. They save maybe $15 a month by getting the bare minimum, but they expose themselves to a lifetime of debt. Raising your liability limits from, say, 25/50/25 to 100/300/100 often costs less than you think, and it's the single best investment you can make in your financial security. So, liability covers them. But what about you? What about your car? That's where the physical damage coverages come in: collision and comprehensive. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, a building, you name it. Crucially, it pays out regardless of who is at fault. So if you slide on ice and hit a fence, collision has your back. If someone hits you and they don't have enough insurance, collision has your back. Comprehensive coverage, sometimes called other than collision, is for almost everything else. This is the coverage for all the weird, unpredictable events that can damage your car. Think of it as the acts of God and criminals policy. A tree branch falls on your car during a storm? That's comprehensive. Your car gets stolen? Comprehensive. Vandalized? Comprehensive. You hit a deer on a dark country road? That's comprehensive. Hail damage, fire, flooding. All comprehensive. Now, both collision and comprehensive come with a deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. It's your share of the risk. Deductibles typically range from $250 to $2,500. Let's say you have a $1,000 deductible, and you get into an accident that causes $5,000 in damage to your car. You pay the first $1,000, and the insurance company pays the remaining $4,000. Here's the strategic part. A higher deductible means a lower monthly premium. A lower deductible means a higher premium. The key is to choose a deductible you could actually afford to pay tomorrow if you had to. Don't pick a $2,000 deductible to save $20 a month if you don't have $2,000 in an emergency fund. You'll have coverage you can't even use. For non-standard drivers, this is a critical calculation. If you're driving an older car worth, say, $2,000, does it make sense to pay for collision coverage with a $1,000 deductible? Maybe not. You might be paying hundreds of dollars a year to protect a potential $1,000 payout. You have to weigh the cost of the coverage against the value of your car. However, there's a huge catch. If you have a loan on your car or you're leasing it, the bank or finance company will almost certainly require you to carry both collision and comprehensive. They own the asset and they want it protected. Okay, so we've covered the other person's body, the other person's car, and your car. What about the most important thing? What about your body? This is where personal injury protection, or PIP, and medical payments coverage, or MedPay, come in. PIP is mandatory in about a dozen states known as no-fault states, places like Florida, Michigan, and New York. In a no-fault system, your own insurance company pays for your medical bills after an accident, up to your policy limit, regardless of who was at fault. This is designed to speed up the payment process and keep smaller injury claims out of the court system. PIP is fantastic because it not only covers medical expenses for you and your passengers, but it can also cover lost wages if you can't work, and even services you can no longer perform, like childcare. If you don't live in a no-fault state, you can usually buy medical payments coverage, or MedPay. It's similar to PIP, but generally less comprehensive. MedPay covers medical and funeral expenses for you and your passengers after an accident, also regardless of fault, but it typically doesn't cover lost wages. MedPay is often very affordable, and is a great way to ensure you have a safety net to cover your health insurance deductible or copays if you're injured. Now for the last and arguably one of the most important pieces of the puzzle. You've done everything right. You've got great liability limits, you've protected your car, you've covered your own medical bills. You are a responsible driver. But what happens when the person who plows into you is the exact opposite? What if they have no insurance at all? Or they have the state minimum and your medical bills are 10 times that? This is where uninsured and underinsured motorist coverage saves the day. It's insurance you buy to protect yourself from people who don't have insurance or don't have enough of it. Uninsured motorist coverage, or UM, kicks in when you're hit by a driver with no insurance or in a hit and run. It comes in two parts, just like liability. Uninsured motorist bodily injury, UMBI, pays for your medical bills and lost wages, and uninsured motorist property damage, UMPD, pays to repair your car. Underinsured motorist coverage, or UIM, is for a slightly different but equally dangerous scenario. Let's say you get hit by someone who did the legal thing and bought the state minimum 25/50/25 policy. But the accident is severe. You're airlifted to a trauma center, you need multiple surgeries, and your total medical bill is $150,000. The other driver's insurance will pay their policy limit. That's $25,000. That's it. They're done. What about the other $125,000? Without UIM coverage, you're stuck trying to sue a person who likely has no assets to begin with. But if you have underinsured motorist coverage, your own insurance company steps in and covers the gap, up to the limits you selected. In many states, it is shockingly cheap to add high limits of UM/UIM coverage. Given that the Insurance Research Council estimates that 1 in 8 drivers on the road is uninsured, skipping this coverage is a massive gamble. You are betting your entire financial future that every single person you share the road with is as responsible as you are. And that, my friends, is a bet you are likely to lose. So what happens when you lose that bet? What happens when the dust settles, the metal is crunched, and the bills start rolling in? The at-fault driver is uninsured. Or their pathetic state minimum policy is just a drop in the ocean compared to your medical expenses. This is where the game changes. This is where you stop relying on the responsibility of strangers and start relying on the smartest decision you made when you bought your policy. We're talking about covering you, your passengers, your family. We're talking about your first line of defense, medical payments coverage or MedPay, and its bigger, stronger cousin, personal injury protection, or PIP. Let's start with MedPay. Think of it as your accident health insurance. It's simple, it's direct, and it's incredibly fast. MedPay covers reasonable and necessary medical and funeral expenses for you and your passengers after an accident, regardless of who was at fault. Let me repeat that because it's the most important part. Regardless of who was at fault. Someone runs a red light and T-bones you? Your MedPay can kick in. You swerve to miss a deer and hit a tree? Your MedPay can kick in. You are a passenger in your friend's car, and they cause an accident? Your MedPay from your own policy can still cover you. It's designed to be immediate. While the other driver's liability insurance is busy investigating, debating, and delaying, your MedPay is designed to pay out right away. This isn't for a big fat settlement check down the line. This is for the here and now. This is for the ambulance ride that costs $1,000. This is for the emergency room visit, the x-rays, the stitches. It's for the deductible on your regular health insurance that you can't afford to pay out of pocket. It can even cover things your health insurance might not, like dental work if a tooth gets chipped, or chiropractic care. MedPay limits are typically lower than other coverages, often sold in amounts like $1,000, $5,000, or $10,000 per person. It's not meant to cover a catastrophic, life-altering injury. It's meant to be the financial first aid kit. It stops the immediate bleeding. Let's imagine you have a $5,000 MedPay limit. You get into an accident and have a $2,000 emergency room bill. Your MedPay can pay that bill directly in full. You don't have to wait for a settlement. You don't have to get a collections notice from the hospital. It's paid. Done. And who does it cover? Covers you, the policyholder. It covers your resident relatives, your spouse, your kids, anyone living in your household, even if they're hit by a car while walking down the street or riding their bike. And it covers any passengers in your insured vehicle at the time of the crash. It's a safety net that you cast over yourself and the people you care about most. In a world where a simple ER visit can run you thousands of dollars, having even a small amount of MedPay can be the difference between a manageable inconvenience and the start of a deep, dark financial hole. But what if you need more? What if the injury isn't just a few stitches and a follow-up visit? What if it keeps you out of work? This is where we move from the first aid kit to the full-blown trauma center. This is personal injury protection, or PIP. Think of PIP as MedPay on steroids. It does everything MedPay does. It covers medical bills regardless of fault, but it goes so much further. The single most important, life-changing benefit of PIP is that it can cover lost wages. If an accident leaves you unable to work for 2 weeks, 2 months, or even longer, PIP can replace a percentage of your income. For anyone who lives paycheck to paycheck, this is not just a benefit, it's a lifeline. The at-fault driver's insurance might eventually pay for your lost wages, but that could take a year of fighting. A year. Can you go a year without a paycheck? Can you pay your rent, your car note, your utility bills with the promise of a settlement that might never come? PIP pays you now when you need it most. Let's paint a picture. David is a freelance contractor. If he doesn't work, he doesn't get paid. He's in a crash that wasn't his fault, and he suffers a broken leg. The doctor says no work for 8 weeks. Without PIP, David is facing financial ruin. He's calling his landlord, begging for an extension. He's running up credit card debt just to buy groceries. But David has PIP coverage. Within a couple of weeks, his PIP carrier starts sending him checks, covering a significant portion of his lost income. The stress doesn't vanish, but the panic subsides. He can focus on healing, not on impending eviction. That is the power of PIP. And it doesn't even stop there. PIP can also cover what's called essential services. This is another game changer people rarely know about. Let's say you're a single parent and a car accident leaves you with a back injury that prevents you from cleaning your house, doing laundry, or even taking care of your kids. PIP can provide money to hire someone to do those things for you. It recognizes that your ability to function in your daily life has a real monetary value. Now you might be thinking, this sounds amazing, why doesn't everyone have it? Well, in about a dozen states known as no-fault states, you don't have a choice. States like Florida, Michigan, New York, and others mandate that every driver carry PIP. The whole idea behind a no-fault system is to reduce lawsuits and get money into the hands of injured people faster. In these states, after an accident, you turn to your own PIP coverage first for your medical bills and lost wages, no matter who caused the crash. You don't have to prove the other guy was wrong. You just have to prove you were injured in the accident. This is a critical concept to understand. In these no-fault states, there are often limitations on your right to sue the other driver. You typically can't sue them for pain and suffering unless your injuries meet a certain threshold, which could be a specific type of injury, like a permanent disability or disfigurement, or your medical bills exceeding a certain dollar amount. The system is designed to handle the vast majority of claims quickly and efficiently through PIP, saving the courts for only the most serious cases. So let's break down the final showdown: MedPay versus PIP. MedPay is optional in most states and focuses solely on medical and funeral expenses. It's a fantastic, affordable supplement to your health insurance. PIP, on the other hand, is required in no-fault states and optional in a few others. It's a comprehensive package covering not just medical bills, but also lost wages and essential services. It's a true financial shield against the chaos an accident can cause. For a driver in the non-standard market, these coverages are not a luxury. They are arguably more important than for anyone else. If you're working to rebuild your credit or have a tight budget, you likely don't have a 6-month emergency fund sitting in the bank. You don't have the financial cushion to absorb a $5,000 medical bill or go a month without a paycheck. A car accident without this coverage isn't just a setback, it's a potential checkmate. It can undo years of hard work in an instant. It can force you into debt that will follow you for a decade. Choosing these coverages is an act of self-preservation. You are making a conscious decision to protect your body, your health, and your ability to earn a living. You are insulating yourself from the financial fallout of a crash, whether it's your fault or the fault of that uninsured driver we just talked about. It ensures that a physical crisis doesn't automatically become a financial one. We've now covered the complex web of liability. We've covered how to protect yourself from irresponsible drivers. And now we've covered how to protect your own health and your income. We've built a fortress around the people inside the car. But what about the car itself? What happens when your $1,000 commuter car, or your $30,000 pride and joy, is a twisted wreck on the side of the highway? Protecting your property is a whole different ballgame. And it's where the next two giants of auto insurance come into play. Let's start with the first one, the one that deals with the crunch of metal against metal, the sickening sound of a fender bender or something much, much worse. This is collision coverage. The name is pretty straightforward, but its power is immense. Collision coverage pays to repair or, if necessary, replace your own vehicle after it's damaged in an accident with another object. That object is usually another car, but it could also be a telephone pole, a guardrail, a fire hydrant, or even the pavement if your car flips over. Here is the single most important thing to understand about collision coverage. It pays out regardless of who is at fault. Let that sink in. Regardless of fault. Imagine you're driving home late one night. It's raining, the roads are slick. You take a turn a little too fast, hydroplane for a split second, and slam right into a concrete barrier. Your fault? Absolutely. You were driving too fast for the conditions. If you only have liability coverage, your insurance company will pay to fix the city's concrete barrier you just crunched. But your car? The one with the front end that now looks like an accordion? That's on you. You're looking at a tow truck bill, a massive repair bill, or the total loss of your vehicle. You're taking the bus to work tomorrow, and for the foreseeable future. Now rewind that scene. Same rainy night, same mistake, same crumpled front end. But this time you have collision coverage. You're still shaken up, you're still annoyed at yourself, but you're not financially ruined. You call your insurance company. You'll have to pay your deductible, we'll get to that in a second, but after that the insurance company steps in. They'll pay the thousands or even tens of thousands of dollars to either repair your car to its pre-accident condition or, if it's a total loss, they'll cut you a check for the actual cash value of your car. You're not just buying repairs, you're buying a lifeline. But what if the accident isn't your fault? What if you're sitting at a red light and a driver texting on their phone plows into the back of you? Their liability insurance should cover your car, right? Yes, it should. But what if they don't have insurance? 1 in 8 drivers in America is uninsured. What if they have the bare minimum state-required coverage, and your car is worth more than their policy limit? Or what if their insurance company decides to drag its feet investigating the claim for weeks while your car sits gathering dust in a repair yard. This is another superpower of collision coverage. You don't have to wait. You can file the claim under your own policy. You pay your deductible, get your car fixed, and get back on the road in days, not months. Meanwhile, your insurance company will go to war for you. They'll track down the at-fault driver and their insurance company to get their money back, including your deductible. This process is called subrogation, and it means you have a multi-billion-dollar company fighting on your behalf so you don't have to. You get your car back, and you get your deductible back, all without having to play collections agent. So, what is this deductible I keep mentioning? A deductible is the amount of money you agree to pay out of pocket for a claim before your insurance coverage kicks in. It's your skin in the game. Deductibles for collision typically range from $250 to $1,000, or even more. Let's say you have a $500 deductible, and you get into an accident that causes $8,000 in damage. You pay the repair shop the first $500, and your insurance company pays the remaining $7,500. Choosing your deductible is a crucial financial decision. A higher deductible means you're taking on more personal risk, so the insurance company rewards you with a lower premium. A lower deductible means less risk for you, so your premium will be higher. For someone in the non-standard market, it's a constant balancing act. A high $1,000 deductible might make your monthly payment affordable. But do you have $1,000 ready to go if an accident happens tomorrow? It's a question you have to answer honestly. Now let's talk about collision's partner in crime: comprehensive coverage. If collision is for accidents, comprehensive is for, well, almost everything else. It's the life happens coverage. Comprehensive pays for damage to your car that's not caused by a collision. It's sometimes called other than collision coverage for this very reason. This is the coverage for the bizarre, the unpredictable, and the unfortunate acts of God and humanity. Let's run through a list because this is where people are often shocked at what's covered. Your car is stolen and never recovered? Comprehensive covers that. A thief smashes your window to grab your laptop bag? Comprehensive covers the broken window. A hailstorm pummels your car, leaving it looking like a golf ball? Comprehensive. A tree branch snaps in a windstorm and crushes your roof? Comprehensive. You're driving down a country road at dusk and a deer leaps out in front of you? That's not a collision with an object in the traditional sense. It's an encounter with an animal, and it falls under, you guessed it, comprehensive coverage. Fire, floods, riots, vandalism, all of this falls under the comprehensive umbrella. Think about it. You could be the safest driver in the world with a perfect record, and still walk out of your apartment one morning to find your car gone. Or find that a fire in your building's parking garage has turned your vehicle into a charred husk. None of that is your fault. None of it involves a driving error. Without comprehensive coverage, you are completely on your own. You'd still be making payments on a car that no longer exists. With comprehensive, you file a claim, pay your deductible, which is often lower for comp claims than collision claims, and you get a check for your car's value. So this brings us to the ultimate question for any driver, but especially a non-standard driver trying to keep costs down. Do you actually need collision and comprehensive? Unlike liability insurance, which is legally required, these two are often optional. But there's a huge exception. If you have a loan on your car or you're leasing it, they are not optional. Your lender or leasing company will absolutely require you to carry both. Why? Because until you pay it off, that car is their asset. It's the collateral for your loan. They need to make sure their investment is protected from your driving mistakes, deer, thieves, and hailstorms. If you let that coverage lapse, your lender can and often will buy a policy for you called force-placed insurance and tack the outrageously high cost onto your loan payment. But what if you own your car outright? What if you paid cash for it? Now you have a choice, and the decision really boils down to two things: the value of your car and your personal financial safety net. If you're driving a 15-year-old clunker worth $1,200, does it make sense to pay an extra $90 a month for full coverage? Probably not. Over the course of a year, you'd be paying over $1,000 in premiums to protect a $1,200 asset. In this case, it might be wiser to self-insure. That means you skip the coverage, take the money you would have spent on premiums, and stick it in a savings account. If the car gets totaled, you use that saved money, plus the car's scrap value, to buy another beater. But what if your car is worth $5,000? Or $10,000? The math starts to change. The key question you must ask yourself is this: if my car was totaled tonight, could I afford to replace it tomorrow without causing a major financial crisis in my life? Could I still get to work? Could I still take my kids to school? If the answer is no, then collision and comprehensive aren't a luxury. They are a critical tool for managing risk. They are the barrier standing between one bad day and a months-long financial disaster. So we've covered your legal duty to others with liability insurance. We've now covered protecting your own vehicle, your property, with collision and comprehensive. We've built the foundation of a solid policy. But there's still one critical element we haven't talked about. We've protected the other driver. We've protected the cars. But what about the most valuable thing involved in any accident? What about you? What about your passengers? What happens when the damage isn't to steel and glass, but to flesh and bone? Protecting people is the next and arguably most important layer of your insurance armor. This is where the numbers on your policy stop being abstract figures and become a shield against financial catastrophe. Because when a lawsuit lands on your doorstep, it's not asking for the blue book value of a bumper. It's asking for a lifetime of medical care, lost wages, and pain and suffering. Let's start with the cornerstone of protecting others: bodily injury liability. This is the big one. If you cause an accident and someone in the other car, or a pedestrian or a cyclist, is injured, this is the part of your policy that pays for their medical bills, their lost income, and potentially legal settlements. Every state, with the exception of Florida, which has a unique system, requires you to carry this. Now, you'll often see this written as two numbers like 25/50. This can be confusing, so let's break it down. The first number, the 25, stands for $25,000. That is the maximum amount your insurance will pay for any one single person's injuries in an accident you cause. The second number, the 50, stands for $50,000. That is the maximum total amount your insurance will pay for all injuries combined in a single accident. So imagine you cause a 3-car pileup. One person has $30,000 in medical bills, another has $15,000, and a third has $10,000. That's a total of $55,000. Your policy, with its 25/50th limit, would pay the first person the maximum of $25,000. They're still short $5,000. It would pay the second person their full $15,000, and the third person their full $10,000. That adds up to $50,000, your per accident limit. You've maxed it out. What happens to the remaining $5,000 the first person is owed? They can, and likely will, sue you personally for it. And what if someone's injuries are truly severe? A single night in an ICU can cost more than that entire $50,000 limit. A helicopter airlift? Forget about it. Suddenly, the state minimum doesn't look like a safety net. It looks like a tightrope with no net at all. When people talk about being underinsured, this is what they mean. You're legally compliant, but you are one bad day away from having your wages garnished, your savings wiped out, and a lien placed on your home. This is especially critical for non-standard drivers. The temptation to just get the cheapest state minimum policy is huge. But doing so is like bringing a garden hose to a house fire. It's a gamble against your entire financial future. Okay, so that covers everyone else. But what about the people inside your car? What about you? Liability coverage does nothing for you if you're at fault. This is where the next layers of armor come in. The first is called medical payments coverage, or MedPay. Think of this as a small, fast-acting fund for medical expenses for you and your passengers, regardless of who caused the accident. It's no-fault goodwill in your pocket. Let's say you slam on the brakes to avoid someone, and your passenger hits their head on the dashboard. It's not a major injury, but they need to go to the emergency room for a checkup and maybe some stitches. That visit could easily cost $1,000. Instead of fighting over who pays or waiting for a settlement, MedPay steps in and covers it right away. It's usually sold in smaller amounts, $1, $5, maybe $10,000. It's fantastic for covering health insurance deductibles, co-pays, ambulance rides, or dental work if a tooth gets chipped. It's relatively inexpensive to add, and it provides immediate peace of mind. In a world of medical billing nightmares, MedPay is the simple, fast solution. Now, if you live in one of the dozen or so no-fault states, like Florida, Michigan, or New York, you'll have something even more powerful: personal injury protection, or PIP. PIP is like MedPay on steroids. It's mandatory in these states, and its purpose is to reduce lawsuits by making sure every driver's own insurance covers their initial injuries, no matter who is to blame. But PIP goes way beyond just medical bills. This is the crucial difference. PIP can also cover a percentage of your lost wages if you can't work because of your injuries. Let's say you're a freelance contractor. And a broken leg from a car accident puts you out of commission for 2 months. Who pays your rent? Who buys your groceries? IP does. It can also cover things like rehabilitation costs, or even hiring someone to help with household chores if your injuries prevent you from doing them yourself. It is a comprehensive safety net, designed to keep your life from completely derailing after an accident. The limits are typically much higher than MedPay, and it is an absolutely essential piece of your policy in the states where it's offered. So we've covered them and we've covered you. But what if the person who hits you has no insurance at all? Or what if they have one of those bare-bones state minimum policies we just talked about? You could have $500,000 in medical bills, and their policy only covers the first $25,000. This scenario is terrifyingly common. The Insurance Research Council estimates that 1 in 8 drivers on the road is uninsured. That's more than 30 million vehicles. You are sharing the road every single day with people who have absolutely no way to pay for the damage they might cause. This is where your final and arguably most important defensive shield comes into play: uninsured and underinsured motorist coverage. UM and UIM. This is the coverage that protects you from the irresponsibility of others. Let's paint the picture. You're sitting at a red light, and you get violently rear-ended. The other driver gets out, says, "I'm so sorry, I don't have insurance." And now you're left with a crumpled car and a searing pain in your neck. Your bodily injury liability won't help. You didn't cause the accident. Your health insurance might cover some of the bills, but you'll have deductibles, copays, and coverage limits to deal with. What about your lost wages? Your pain and suffering? This is where uninsured motorist bodily injury coverage saves you. It steps into the shoes of the at-fault driver's insurance, the insurance they should have had, and it pays for your medical bills, your lost income, and your suffering up to the limits you select. You are essentially buying an insurance policy for the person who hits you, just in case they failed to buy one for themselves. The second part, underinsured motorist, is just as critical. Let's go back to that same accident. This time, the driver who hit you does have insurance, but it's the state minimum $25.50 its policy. Your injuries are severe. You need surgery, months of physical therapy. Your total medical bills come to $100,000. Their insurance pays its maximum of $25,000 and then walks away. You are left with a $75,000 bill. This is where underinsured motorist coverage kicks in. It covers the gap between what the other driver's policy paid and the actual cost of your injuries, again, up to the limits you chose. Many people, especially those looking for non-standard insurance, skip this coverage because it's not always mandatory. This is a colossal mistake. You can be the safest driver in the world, follow every rule, and still have your life turned upside down by someone else's recklessness and lack of preparation. Forgoing UM/UIM coverage isn't saving money. It's betting your health and financial stability on the hope that all 30 million uninsured drivers on the road will manage to avoid you. It is a bet you cannot afford to lose. So we've built the fortress. We have liability to protect our assets from others. We have collision and comp to rebuild our vehicle. And we have MedPay, PIP, and UM/UIM to rebuild our bodies and our lives. We've covered the car, we've covered the other driver, and most importantly, we've covered ourselves. Each piece is a critical plate of armor. But knowing what the armor is made of is only half the battle. How do you find the right policy? How do you navigate the quotes, the companies, the discounts? How do you put all this knowledge into action to get the best possible protection without it costing a fortune? That is the final practical mission we need to accomplish. Let's break down that mission into a clear step-by-step battle plan. This is the exact process you can follow starting today to find the best possible non-standard auto insurance policy. First, you need to gather your arsenal. Before you make a single call or click a single link, get all your information in one place. You'll need your driver's license number, the vehicle identification number, or VIN, for every car you need to insure, and the address where they'll be parked. But most importantly, you need to be brutally honest with yourself about your driving record. Pull a copy of your motor vehicle record, or MVR, from your state's DMV. Know the exact dates of any accidents or violations. Hiding something at this stage is pointless. The insurance company will find it when they run your record, and the quote they gave you will either vanish or skyrocket. Honesty and accuracy from the start saves you time and frustration. Step 2 is to define your target. What does your ideal policy actually look like? Don't just think about the state minimum. We've established that's often a financial trap. Decide on the liability limits you're comfortable with. Do you want 25/50/25? 50/100/50? More? Do you need comprehensive and collision coverage to protect your own vehicle? What deductible can you realistically afford to pay out of pocket if you have to make a claim? $500? $1,000? Write this down. This is your blueprint. You're no longer just asking, how much is insurance? You're asking, how much is this specific policy that I have designed for my needs? Now, with your information gathered and your target defined, the hunt begins. This is step 3, choosing your hunting ground. You have 3 primary options. The first, and often the most powerful for non-standard drivers, is an independent insurance agent. Think of them as a specialist guide. They don't work for one company. They work for you. They have relationships with multiple carriers, including many of the smaller, specialized non-standard companies that you might never find on your own. You tell them your story, give them your blueprint, and they go to work, shopping the market on your behalf. They know which companies are more forgiving of a DUI, and which ones are better for drivers with a salvage title. This is their world. Your second option is using online comparison websites. These can be a good starting point to get a broad sense of the market. But be cautious. They often prioritize the big, standard carriers who may instantly decline you or give you an astronomical quote. They don't always have access to the full spectrum of non-standard insurers. Use them to get a baseline, but don't let it be your only stop. Your third option is going direct to the source. Companies like the General, Safe Auto, or Progressive have robust systems for quoting non-standard drivers directly on their websites or over the phone. If you know you're in the non-standard category, going directly to a few of these specialists is a smart move to compare against what an independent agent finds for you. Step 4 is decoding the offers. You'll start getting quotes back, and this is where your blueprint is critical. Don't just look at the monthly price. Put the quotes side by side. Does quote A have the 50/100/50 liability limits you wanted, while quote B is cheaper but only offers the state minimum? Does quote C have the $1,000 deductible you specified, while quote D is more expensive because it defaulted to a $500 one? You must compare apples to apples. Look at the exact coverages, limits, and deductibles on each quote to make a true comparison. The cheapest price is often attached to the weakest policy. Once you have comparable quotes, it's time for step 5. The discount deep dive. This is not a passive process. You have to actively ask for every single discount you might qualify for. Ask your agent or the company representative, what discounts am I eligible for? Then get specific. Do you offer a discount for completing a state-approved defensive driving course? If you haven't taken one, find one online. A few hours of your time could save you hundreds of dollars. Ask, is there a discount for paying the entire 6-month or 1-year premium upfront? This can often save you 5 to 10%. Ask about discounts for safety features like anti-lock brakes, airbags, or an anti-theft system. Ask about low-mileage discounts if you don't drive much. Leave no stone unturned. Every dollar you save is a victory. And if you need in-state Route 22 or FR 44, the process is simple. You don't go out and get in-state Route 22 form yourself. You find the insurance policy first. During the checkout process, you tell the insurance company that you require in-state Route 22 filing. They will charge you a small filing fee, usually around $25, and then they will electronically file the proof of insurance directly with your state's DMV on your behalf. It's an integrated part of the sign-up process, not a separate task you have to handle. Finally, before you sign on the dotted line, there's one last critical check: company reputation. A policy is only as good as the company's ability and willingness to pay a claim. A rock-bottom price from a company with a terrible claims process is a terrible deal. Do a quick search for reviews on the company you're considering. Look at their customer service ratings, their claim satisfaction scores. You're not just buying a piece of paper, you're buying a promise. Make sure it's a promise from a company that can be trusted to deliver when you need them most. By following these steps, gathering your info, defining your needs, shopping smart, comparing accurately, and digging for discounts, you will navigate the non-standard market like a pro. You will find the best possible coverage for your situation at the most competitive price. But our mission doesn't end there. Getting the policy is just the beginning. The ultimate goal is to get back to the standard market and the lower premiums that come with it. Non-standard insurance should be a temporary bridge, not a permanent destination. So how do you cross that bridge? You create a long-term plan for redemption. First, and most obviously, you have to drive clean. Every single day that you drive without a ticket or an accident, You are actively repairing your insurance profile. It's the single most important thing you can do. Second, you must maintain continuous insurance coverage. Do whatever it takes to never miss a payment. A lapse in coverage, even for a few days, is a massive red flag to insurers. It resets the clock on building trust and can keep you in the high-risk pool for much longer. Set up automatic payments. Treat your insurance bill with the same importance as your rent or mortgage. Third, mark your calendar. Know exactly when your major violations or accidents are set to fall off your driving record. For most states, this is between 3 to 5 years. The day that major ticket from 3 years ago is no longer on your MVR is a day to celebrate, because your insurance risk profile has just dramatically improved. And that leads to the final crucial step: you have to be proactive. Your current insurance company has no incentive to tell you when you might start qualifying for better rates. You have to force the issue. Every 6 months, or at the very least once a year on your policy renewal date, you must reshop your insurance. Go through the exact same process we just outlined. Get new quotes from an independent agent and other carriers. As your record cleans up and time passes, you will see the quotes start to drop. One day, you'll get a quote from a standard carrier that's not just competitive but better. And on that day, you will have successfully crossed the bridge. What we've covered in this journey is more than just an explanation. It's a roadmap. It's the key to taking control of a situation that can feel overwhelming and powerless. Non-standard auto insurance isn't a punishment. It's a system. And now, you understand that system. You know the rules, you know the players, and you know the strategy. It's a tool that allows you to stay on the road, to get to work, to live your life, all while you are actively rebuilding your record. You are no longer just a high-risk driver. You are an informed consumer with a plan. Use this knowledge. Follow the steps. Drive safely, and reclaim your path to a better, more affordable insurance future. You can do this.